Hello everyone and a warm welcome to the webinar. This is the second in a new series of webinars exploring tax issues that affect businesses, and we are happy that you've joined us today. My name's Amy Jack and I'm joined by my colleagues George Milmine and Katie Hall from our employment taxes team.
Morning, everyone. Sorry.
That's okay. They assist a wide range of clients, ranging from charities and independent schools to larger corporates, and they advise clients in all sectors, so have lots of experience. But before we get started, I did have a few housekeeping points to run through. This webinar is being recorded. It will be available on our website afterwards and will be kept for up to a year. And just to reassure you that no attendees can be seen or heard. We would love for you to submit some questions. We'll try and save some time for these at the end of the webinar. There should be a Q&A box at the bottom of your screen. So if you do want to submit questions, that's the way to do it, please. And after the session, you will receive an email with a link to the recording. So onto the agenda. For this morning's webinar, George and Katie are going to cover two main areas. First, they'll talk about the various employment tax changes announced at the budget and explain the impact of those. And the second part of the webinar, the focus will turn more to P11Ds, and we'll look at the pitfalls and common errors. So you should hear some really useful tips that will help you stay compliant and avoid HMRC scrutiny. So onto the first topic. As I'm sure you're all aware, we had the autumn budget on the 26th of November, which delivered targeted changes rather than sweeping reform. So we did have changes to capital allowances, and growth incentives were strengthened through expanding investment schemes. We always do get rumours ahead of a budget, and this time many of the rumoured changes didn't happen. There were, however, a number of changes in the areas of employment taxes, and I will hand over to George and Katie to explain more about those. Thank you.
Good morning, everyone. I'm Katie Hall. I'm a manager in the employment tax team at Saffery, and this morning I'm going to run through all of the employment tax highlights of the 2025 autumn budget. This year, as Amy mentioned, it was all quite dramatic with various leaks to the press and with the early publishing of the OBR report before the Chancellor even started speaking. Though, as always, the devil is in the detail, and that's what I'm here to bring you today. So jumping straight in there, personal tax thresholds have been frozen right up until 2031. Previously, they had been frozen, but only up until 2028. So this is very much a stealth tax and will certainly raise a lot of money for the Chancellor. The effects of fiscal drag will mean that around 750,000 more people will now be dragged into the higher rate tax band. And approximately, it's estimated around 1 million people will start to pay tax who hadn't previously. So just to run through those rates then, income tax personal allowance has been frozen at £12,570. The higher rate threshold is frozen at £50,270, and the additional rate threshold frozen at £125,140, all for the same period. The NIC bands, both employee and employer, have also been frozen for the same period of time. Just to flag as well, these rates are for England and Northern Ireland only. Both Scotland and Wales can set their own rates, albeit Wales haven't chosen to do that yet. Just another thing to flag as well, plan to student loan repayment threshold. This has been frozen too. The way this works is essentially like another kind of tax, charged at 9% on any earnings above the threshold set. So currently the threshold set at £28,470. This will increase to £29,385 from April next year. After that, it will be frozen right up until 2030-31. Next up, this is a big one for us, is the capping of national insurance contributions relief on pension salary sacrifice arrangements. So just to recap on this one then, under a pension salary sacrifice agreement, if you have one in place, your employees will sacrifice a portion of their salary, and then you as the employer pay that sacrificed amount directly into your employee's pension contribution instead. So employer contributions are currently free from both tax and employee and employer NI. So many employers utilize salary sacrifice for pension contributions, and a large portion of these passed at least some of their own savings onto employees as well, on those NICs. So currently that amount is unlimited. However, from April 2029, the sacrificed amount available for relief will be capped at £2,000 per tax year. So what that means is for anyone contributing, say 5% of their salary, if they earn over 40k, then their NIC relief will be limited. It may still be beneficial to sacrifice salary without the NIC relief. So for example, some people might lose their entitlement to tax-free childcare or child benefits, or the abatement of the personal allowance. Also, on a slightly more selfish note as well, pension salary sacrifice reduces my student loan repayment deductions because this is based on gross nickable salary. So obviously it doesn't come in until April 2029. There is still some time to go before this comes in place. And also it is still a very good scheme to have in place if you don't already have as an employer, because there are still significant savings to be made even after the cap is introduced. Just to be clear as well on this, the cap of relief only applies to salary sacrifice pension contributions and not to other benefits that benefit from salary sacrifice schemes, such as cycle to work and electric vehicle company car schemes. There's still no cap on these. Okay, so next up, image rights payments. So this is a big one for footballers and other sports people, really. So generally, the way that these work is that individuals will receive a payment for playing their sport, and then a separate payment for image rights, and this is generally around 15%. And the way this works is normally they put that into a separate company and use it as a kind of informal pension fund. From April 2027 onwards, however, all image rights payments related to an employment will be treated as employment income. So this does appear to only cover payments from employer to employee, so doesn't affect any third-party endorsement payments, but it will include deemed employments. So for those who are considered employees under IR35 rules, this will apply. Okay. Next up then, we have the abolition of voluntary Class 2 NICs. So from April 2026, non-UK tax residents will no longer be able to pay Class 2 NICs voluntarily, and as such, they'll be unable to preserve or accrue UK state pension entitlement through these contributions. However, Class 3 voluntary payments will still be available. Previously, these were a less popular option because the payment amounts tended to be higher and the benefits just weren't as good, but there is still an option here. Okay, next up is the add-on rates to electric vehicle exercise duty for electric vehicles and plug-in hybrids. So from April 2028, an EVED charge will be levied on electric vehicles and plug-in hybrids to be based on their mileage, with the average electric vehicle driver set to pay around £240 per year or £20 per month, according to the government's estimations. This will be in addition to the current vehicle exercise duty paid by electric and non-electric vehicle drivers alike. So it's understood that mileage will need to be estimated and reconciled each year, and the pence per mile payment of 3p is due in respect of electric vehicles, and 1.5p for plug-in hybrid electric vehicles. As yet, we're unclear exactly how this payment will need to be made, but the government has launched a consultation on the introduction of the new charge, and this will run until the 18th of March 2026. So we'll know more when that concludes, hopefully. So for employees in a company car, this will be an additional cost to the employer. And they'll need to keep records of the employee's mileage each year, estimated and actual. But for now, we don't expect that the EVED will give rise to any additional benefit in kind charges. It should be treated in the same way as the standard existing VED as part of the company car benefit. So employees in their own cars traveling on business will likely look to their employers for reimbursement of the EVED, and therefore they will need to maintain adequate records for this purpose. It's also likely that HMRC will need to agree that employers can reimburse these costs and the process to do these without an earnings charge arising. Otherwise, employees may claim mileage relief as they would do for fuel and electric costs. Hopefully HMRC do increase the mileage rates accordingly to include the charge. As far as I'm aware, they haven't changed in years. So this would be good, but we will see. Okay, so next up, we have the enterprise management incentive schemes. So also known as an EMI. EMI schemes are they're a really popular tax-advantaged employee share scheme. The scheme allows companies to provide their employees and executives with tax-advantaged share options. So the business value grows, their employee can exercise their share options, acquire shares, and sell them. So if the exercise price is at least equal to the market value of the shares at the time the option was granted, there's no income tax or NIC due on the exercise at all. It's a really good scheme. Any growth in share value between grant and exercise is free from income tax and NICs, but any gains are subject to CGT only. So the scheme has historically had strict rules on the size of business, which can qualify, and the maximum awards that can be made. So now that we're no longer part of the EU, the government can set their own thresholds, which they have done now. So just to run through these quickly, the increase to the qualifying company limits, they've been increased to companies with up to 500 employees, up from 250 employees, and companies with up to £120 million of gross assets, up from 30 million. So quite a big jump there in the gross assets, especially. They've also increased the maximum holding period on share options. So previously this was 10 years. This has now been increased to 15 years. There's also a possibility for employees with existing share options to extend that beyond 10 years without the loss of any reliefs. The number of shares that can be issued by the company has also been increased as well. So previously this was up to the value of 3 million. This has been doubled to 6 million. And the requirement to notify HMRC with respect to your EMI schemes has been removed from April 2027. And we tend to find this is where a lot of companies trip up as well, is the failure to notify, which then invalidates the scheme potentially and removes all of those beneficial tax reliefs. Okay, and then finally then, there's just some miscellaneous benefit points that I wanted to pick up on. So in a welcome move, has been confirmed by HMRC that from 6th of April 2026, the exemptions for qualifying employee eye care and eye tests, home working equipment and flu vaccinations will apply to reimbursed expenses, as well as situations where the employer contracts directly with the provider. So there were some existing exemptions specifically with respect to eye care and home working equipment, but as mentioned previously, this didn't cover reimbursed expenses. So where the employee pays for the costs in the first instance and is then reimbursed by the employer. Previously, these costs weren't allowable by HMRC. Now they will be. Separately for the flu jabs, previously there wasn't a specific exemption for flu jabs. So instead, companies could usually exempt these under the trivial benefits rules. However, that was quite limiting because it meant that the flu jab costs had to be under £50 per person, and they had to be paid for directly by the employer. Again, this is because cash payments aren't allowed as a trivial benefit, and HMRC deems reimbursements to be cash payments. So definitely a welcome move there with respect to flu jabs. And then finally, the home working allowance. Again, this is from April 2026. Employees will no longer be able to claim tax relief on additional household costs under the general expense rules where they're required to work from home, and the employer does not reimburse these costs. So the government have cited high levels of non-compliance as the reason behind this move. And I guess a lot of people became aware of the relief due to COVID when a lot of us were forced to work from home. And perhaps some people continued to claim even though they were not necessarily eligible any longer. Importantly, though, there is a separate exemption for home working expenses where employers can reimburse the actual cost of eligible home working expenses, and this is unaffected by the announcement. Or more commonly, the employer can pay a tax and NI-free homework allowance of £6 per week or £26 per month, as long as the employee works from home under home working arrangements, and this is also unaffected by the change. Okay, so a bit of a whistle-stop tour there, but I'm going to hand over to George now.
Thank you very much, Katie. Good morning, everyone. I hope you're all well today. My name's George Milmine. I'm a senior manager in the employment tax team at Saffery. I've been working in tax and national insurance many years now. In fact, a long time ago now. I started my career in London as a national insurance inspector with the contributions agency as it was then. So I've been working with national insurance, introduction of Class 1A, P11Ds, benefits in kind for many, many years. This delivery today is just going to, and I know I've called it common mistakes, it's just really, I suppose it's just an education for us to look at how some benefits are calculated from point of view of reporting on the P11D. Clearly, P11Ds, they've still got a little bit of mileage left in them. The mandatory payroll and the benefits was pushed back by one tax year by the government recently. So mandatory payrolling will commence from 6th of April 2027. Although even then, there could be occasions when a P11D is still required under P11DB. For example, when you provided a beneficial loan, for example, to an employee, or they've been provided with accommodation, which is a tax and not exempt and subject to income tax as a benefit in kind. So if Katie can move to the next slide, please. I don't have control of the slides. I don't think you can trust me with it. So I'm going to start with transfer of an asset. So when does this happen, transfer of an asset? So this is when you as the employer own the asset, such as, a company car or cycle to work scheme, mobile phones, computer equipment, and you decide to transfer the ownership of that asset to the employee. This typically happens in my experience where, let's say you've got an employee who's on retirement, going to retire. They've used a company car, in the latter years of their employment, and they wish to retain the car. And you'll agree, okay, we'll transfer the ownership of the car to use the employee for you to continue to use. You've got to take into consideration, though, when that event occurs, what is the market value of the car or the asset, and what, if anything, has the employee paid. So basically, there could be a benefit in kind charge, a type of benefit in kind charge. The rule of thumb is that you look at the market value of date of transfer, and you deduct from that any amount paid by the employee. Typically, that will be zero. So you're then looking at what's the market value of this asset when I transfer ownership from the company to the employee. Next slide, Katie. So transfer as an asset. If the asset is previously provided for private use, the taxable amount is the higher of the market value at the date of transfer, or the market value when first provided as a benefit, less any amounts already taxed for prior use. But, in most cases, you're going to be looking at what is the market value at the date of transfer, For example, if you provided computer equipment for office use, that would never have been a benefit in kind anyway. So what's the market value of that asset when you decide to transfer the asset to the employee? Next slide, please. So what is market value? So HMRC define it as the price the asset could reasonably fetch in its current condition on the open market at the date of the transfer itself. And for tax purposes, this is the amount that would be agreed between a willing buyer and a willing seller, acting at arm's length and without compulsion. But essentially what you're looking at there is, again, what is the market value of the asset when you transfer it to the employee? So how do you work out that value? There's a few ways you can look at this. It can be quite tricky. For example, if you had like a car, you would look at maybe 3 independent reviews to see what is the second-hand value of that car at the time of transfer. So you can compare similar items. For example, you can check prices for similar second-hand items on platforms like eBay, Facebook Marketplace, or specialist resale sites, and use at least 2 sources. That's crucial as well. Get at least 2 sources to support your valuation of the asset. For brand new assets, the purchase price is usually accepted as the market value. But for older assets, obviously, you've got to apply depreciation based on age and condition. Next slide, Katie. HMRC have some ready reckoners to provide indicative tables for certain assets. This is particularly used for if you go like a cycle to work scheme and it's come to the end of its life, and you've then got the choice of transferring the bicycle to the employee. HMRC will typically list a range of valuations for the bicycle at that point. Or you could if it's an unusual asset or if it's got a high value, you can look for a professional valuation from a qualified valuer before you actually transfer it. And finally, HMRC's Shared Assets Valuation team can also be consulted for complex cases. In my experience, though, you tend to find that assets being transferred typically will be the laptop or the company car. I tend not to see much more than that in my experience. And when you do this event and you transfer this asset, it's important, obviously, you keep evidence of how you arrived at the market value. So this could be screenshots, valuation reports, depreciation calculations. Have that on your files. As always, if you're subject to HMRC audit, they may request proof if they decide to challenge the valuation. So transfer of assets is something where it's important to get the market value right when it comes to calculating the benefit in kind to be reported on preliminary day. Next slide, please, Katie. VAT. Advert of £1. If I had £1 for every time I see clients reporting benefits either on a preliminary or indeed through the PSA without adding the VAT, it's crucial for any benefit in kind that you report the gross value inclusive of VAT. I've got a client recently who have been doing a PSA for many years, and they've just been putting in the net cost in the PSA of the benefit rather than the VAT inclusive cost. This has been picked up by HMRC with PSAs, those who've entered into PSAs, and I will touch on them later. The value of the benefit is grossed up for tax, so you've got quite an expensive exposure if you get it wrong. So it's crucial that the VAT is included in the cost of the benefit being reported. As I say, can be an expensive mistake if you don't do that. Next one, please, Katie. Mileage allowance payments. This is where we're typically AMAP rates, HMRC's approved mileage allowance payments for employees who use their own vehicle for business travel. We're probably all aware of what the rates are. Cars and vans, first 10,000 miles, 45p. Above 10,000, it goes into 25 for tax purposes. Motorcycles, 24p per mile. Bicycles, 20p per mile. So those are the rates. But many of you, and I'm familiar with some public sector bodies, will pay higher mileage allowance rates. So when you as an employer pay more than the AMAP rates, the excess is taxable. And bear in mind as well with AMAP rates that only a fraction of that AMAP rate actually relates to the cost of the fuel that's been put into the car. The bulk of the AMAP rate relates to the upkeep costs that an employee has of upkeeping their own vehicle. So even though you might say, yeah, well, the cost of fuel's rocketed or whatever, HMRC really don't increase these AMAP rates. So they see it as the actual fuel element is not a significant amount compared to the rest of the rates. So bear that in mind. The rates are unlikely to change any time in the future. So when you pay more than 45p or 25p, then obviously the excess is treated as earnings under ITEPA 2003. It's subject to income tax, the employee's marginal tax rate, and crucially, subject to Class 1 NIC. It's treated as earnings, not as a benefit in kind. So bear that in mind as well when reporting it on P11D. So the excess over the AMAP must be reported on the form P11D if you're not processing that excess through payroll. So here's just a wee example for you to look at. You've got an employee drives 12,000 business miles in a year. You're paying 50 pence a mile. Total amount paid is £6,000. So when you look at the approved amounts under the AMAP rates, first 10,000 is at 45p. You get 4.5 there. 2,000 at 25p is 500. So the total payable on the AMAP is £5,000. So clearly there, the excess is £1,000. And that's the amount, that's the taxable and nickable amount, that £1,000. As if you're not processing that through payroll, that's the amount that goes on the P11D. Next slide, please, Katie. So company cars. Now, company cars, honestly, the time when we're doing clients P11Ds, company cars is probably one area where we push back quite a lot for additional information because there's so much information you need to gather to calculate the benefit in kind when you provide a company car which is available for private use to employees. Obviously, the first building block is you've got to look at the list price of the car. And the number of times that we've been given the wrong list price is incredible. The list price of the car is the inclusive price published by the manufacturer. It includes elements such as any sort of relevant taxes, VAT as mentioned earlier, delivery, and if you've got any accessories, additional optional accessories added onto the car, that's all got to get taken into account as the list price of the car. And crucially as well, it's not the dealer's advertised price or the price that you pay, perhaps because that might include discounts and cashbacks. So this discounts and cashbacks have to be excluded from the list price calculation. It's the top line, let's say, list price before any discounts or cashbacks. So if the dealer's giving you a cashback of 3.5k or whatever for a discount, you cannot knock that 3.5k off the list price. The list price has got to be the pre-discount value of the car. Many of you as well will perhaps buy the cars as used vehicles or second-hand vehicles. How do you get the original P11D list price? That can be tricky, but it's crucial again. The list price is not the price you paid for it as a second-hand car. You have to try and dig deep and find what the original list price is. In that situation, there's some very good websites you can look at. For example, Parker's. That's a very good Parker's Guide. It's a very good website that will give you the range of the original list prices of cars for that model for that year when they were new. So I even have used that as a means of working out the list price of cars. I've looked perhaps at Parker's Guide online to get the list price. But remember, if it's a second-hand car, it's not the price you paid for it. You have to look at the price when it was new. And if many of you lease vehicles, and this is very popular with electric car schemes through Octopus or whatever, you will lease the vehicle rather than own it. In that situation, more often than not, I'd expect the car lease company should be able to give you what's called the P11D list price. So again, just ask them for that information. They should be able to provide that to you. What is the P11D list price for the benefit in kind reporting requirements of that vehicle? Plug-in hybrid vehicles. Now, we touched on them with the budget changes. I myself have a plug-in hybrid vehicle. It's not a company car, but it's my own car. I like the concept. I like the electric use and the ability to have a petrol engine as well when the charge runs out. But it's important when you're looking at reporting a company car that is a FEV, you have to look crucially at what is the electric only mileage range. So, for example, in the next slide, I've got a Kia CRSW. It's quite an old one. It's got an electric range of 34 miles. So if that was a company car, you'd be looking as a benefit in kind company car percentage of 13%. Obviously, the new FEVs on the block, more like the Chinese imports, for example, have got really high electrical ranges, and it's not unusual for some of them to be, up in the higher 60s, and indeed I'm seeing some now where it's increasing to over 70 as an electrical mileage range. You can see from this slide here, though, that makes a big difference in the company car percentage, which is then applied to the list price of the car. So there's a big. So it's crucial that you get the electrical range, and that then, that's then applied when you're calculating the P11 days. They are obviously, again, if you don't have the range, if it's a second-hand vehicle, whatever, you can again look at like Auto Express magazine's a good one online. Again, Parker's, they generally will give you a report on the car and they'll indicate what the electrical in the range is. So that can be a good source for information. But if you're doing appealing days and it's a plug-in hybrid, it's very important that you get the electrical in the range correct. Diesel cars, now we still got a lot of people with diesel cars. They're still popular. They're good for people with long distance driving up and down the motorways. No need to charge up, no need to stop. You've got a diesel car, just fill it up and go. Obviously, there was a 4% diesel company car percentage supplement for older diesel cars. Those are more polluting engines, let's say. But generally from January 2021, newer diesel cars from then met what's called Real Driving Emissions 2 standards, RDE2. And what that means is that if your car is RDE2 standard compliant, you don't have this 4% company car supplement. Next slide, please, Katie. So again, it's important. Can you determine, is this car RDE2? Can you save a 4% charge on the company car percentage? And even when I'm doing client P11 days, I'm looking at how do we get this RDE2 information. Most clients don't know, to be honest. They really don't know. It's just a diesel car. So we try to look at areas where we can determine if the car is RDE2. So obviously, first we'll look at the logbook, look at the V5. If it says Euro 6D, Euro 6D temp, the car's RDE2 compliant. And codes like I've listed here indicate compliance as well. As I mentioned earlier, registration date. Most diesel cars registered after Jan 21 are RDE2 compliant. Cars before then can be compliant from January 2020, but again, it's crucial you do a bit more digging and look at the documentation to verify the RDE2. A certificate of conformity, that will often explicitly state if it's RDE2 compliant. There's also a government vehicle inquiry service. You can look in that. Sometimes I've used that, and sometimes it can be a bit hit and miss. Sometimes it won't confirm one way or the other. And the manufacturer should, on their websites, for example, be able to confirm if it's RDE2. And leasing companies, as I say, if you lease the car, they should be aware of all the P11D requirements, i.e. the list price, but also crucially, if it's a diesel car, does it meet RDE2 compliance? So there's some tips there to look at that if you've got any company cars which are diesel powered. Keeping on company cars availability, HMRC are clear. There is what we call 30-day rule, where if the car's unavailable for a strict period of 30 days in a row or more, you can reduce the value of the benefit being reported in the car for the car. This is typically when the car's broken down, it's got a long-term repair, has gone to a garage, not available for use for the employee. One thing to point out, though, is if you're then given a courtesy car, which many insurance companies will do, you'll get a courtesy car as part of the claim, let's say, then obviously, from a point of view of the P11D, you'd still report the original company car as if it was always available for the full tax year. Additionally, some employers misinterpret this 30-day rule. Sometimes you put an order in for a car for an employee, it won't be immediately available. It might, at least local, if you leased it, for example, might say it's available in 30 to 60 days, whatever. Some employers misinterpret this 30-day rule as unavailable when the individual's waiting to get the car. That's not the case. It's when they get the car, that's when the 30-day rule can apply. Next slide, please, Katie. So, this is another one where we get reports in the car. And you'll notice on Appeal 11D, there'll be availability questions. There'll be from and to. If the car is available for the full tax year, just leave those boxes blank. Just don't bother even filling them in. The purpose of these boxes from and to really is for, let's say a car's been made available partway through the year to an employee, or they've changed their car. You would put the to for the end of the first car and from for the start of the new car. Or if it's the first car partway through the year, obviously they'd get a from box. That would then mean that the benefit in kind on the car would be apportioned in line with the number of days that they had the car during the tax year. I have seen no employers just putting in the 5th of April, even though the car's been available for the full tax year. The problem you've got then is that if HMRC think you've got an end date and you've got a due date, they then think that car has essentially been handed back by the employee. And so what happens is when the P11Ds are being processed, and I've seen this on many occasions, come around about August time when the P11Ds are processed, the employee suddenly gets this new tax code and they think, oh, I've got higher net pay, happy days. What they don't realise is that the HMRC think, well, you no longer have this company car benefit, and they've adjusted the tax code appropriately to remove that benefit from the allowance, so to speak. So it can cause all sorts of issues with employee tax codings. Employees can get disgruntled because suddenly they get a tax bill they weren't expecting. Obviously, they should have perhaps said to you, hang on a minute, my net pay is increased, why is that? But let's face it, none of them ever do that. So again, it's crucial. If it's available for the full year, just leave those boxes blank. Car fuel benefit. Now, I'm curious. I wonder how many of you out there with company car schemes still actually provide car fuels. I'll go on in a minute to explain why I don't think it's a good idea. But if you do car fuel benefit, this is an all or nothing charge. So if you say we provide fuel, but none of it's for private use, you really are going to have to keep meticulous mileage records to show that none of that fuel you provided was used privately by the employee. Because the HMRC would look at that and say, well, are you sure about that? Are you sure that the employee did not use that car for 1 mile of private use? And again, this can occur where some employers say, oh, the company car is not available for private use. And I saw one occasion where employees were opting out of private use. But there's so many meticulous records you've got to keep if you're going to do that. It's very, very difficult for an individual not to use a company car privately. Even if they just move it off their driveway or inadvertently take it down the shops, whatever. Any private use at all, or is available for private use, will trigger the benefit charges. So be careful. If you are still providing fuel benefit, have a look at, is it actually cost effective for the employee to do this? And I'll run through a wee example for you here. So this current tax year, the fuel benefit charge went to 28,200. So what that means is, if you've got a company car, you'll look at the company car percentage. The example I'm given, it's 33%. And so therefore the fuel benefit charge would be 33% of 28,200. That's a big chunky number, 9,306. Now, if I'm thinking about it, if you're a higher rate taxpayer, 40% tax on that is £3,722. So you're paying the tax man £3,722 a year for the privilege of your employer giving you an All-Star agency card or whatever, and you getting free fuel. It ain't free. You're paying tax on it. So have a look as well. If I paid for the fuel myself, how many gallons of petrol could I buy with 3,722? In this example, it's 605. If you flick on to the next slide, Katie. If you've got a more fuel efficient car, let's say average MPG is 50, the number of private miles that to break even, let's say with the cost of fuel, tax, etc., you'd have to do 30,000 private miles. So again, have a think. Is it really worth it? Is the fuel benefit charge really worth it? Back one slide, Katie. I tend to say it's not. I would say, look, I did this for a client. They were using the company cars for business use. They were only really using it for private use at employees at weekends. I would say, what do you use it for? Or we go to the golf club, or we go shopping, or whatever. And they were getting nowhere near like even 5,000 private miles, never mind 30,000 private miles. But they had fuel cards and they got the private fuel paid for. So they were getting these large company fuel benefit kind charges. We did a quite straightforward calculation for them. They decided to pull it completely and introduce the concept of the employee actually paying for the fuel themselves and then claiming back the business mileage at HMRC's advisory rates. That, to me, is the way to do it. If you still provide fuel for private use, you can have a word with me if you want later. Again, I don't think it's cost efficient to do it that way. And of course, you've got a Class 1A charge as well on the value of that benefit. So again, have a think about it. Benefits of mixed use. I've seen this quite often. Accommodation being used partly for business, partly for private use. When it's used for privately and business purposes, I have seen employers prorate for benefit in kind purposes for P11Ds, reporting the prorated amount for private use only. That's incorrect. You've got to report the gross value on the P11D. Benefit descriptions. Again, there's some boxes where the box is blank, but you've got to put a description of what the benefit is. Please try and fill those boxes in. It makes life easier for HMRC. Try and avoid just putting other benefits. My recommendation is always put the actual benefit, a description of the benefit in that box. It just makes life a bit simpler for HMRC. In many ways, I'm saving the best for last. I would say overdrawn directors' loan accounts. This is a real headache. And again, I think a lot of people don't know about this, but if you are a director and you've got a loan account with the company, and the loan account was overdrawn, if it's overdrawn at any point in the tax year by £10,000 or more, and you have not been assessed interest and paid the interest on that overdrawn amount on the loan, there is a beneficial loan reporting requirement on the P11D. Again, I've seen this where so many people are not aware of this. It is a beneficial loan charge where the DLA is overdrawn by 10k or more throughout the year. So even if it's overdrawn, you think it's fine, I'm going to draw a dividend, pay it back to the DLA. You've got to be very, very careful that you get the steps correct. Otherwise, you're going to trigger a DLA charge on a beneficial loan charge. It may well be typically just for Class 1 national insurance purposes, but there'll still be a reporting requirement. So obviously, you then look at the normal loan rules, the average rule calculation, unless you'd like to do the more accurate method. Again, you're just looking at what is the loan benefit. You'd have to be reported on P11D. The HMRC's rate of interest now in beneficial ones is now 3.75% rather than 2.25. Some people think that if you roll the interest into the loan, that's fine. It's not. The interest has got to be assessed and physically paid by the 6th of July to mitigate the beneficial loan charge. If it's not done, now if you go back, Kate, if it's not done, then the actual beneficial loan charge still arises. So even if at some point as the dividend voted past the 6th of July, clears the DLA into credit again, you've still got this reporting requirement. So this is probably quite crucial, this one. If you've got directors with directors' loan accounts which are overdrawn, have a look at, is there a beneficial loan charge arising? Have I got to account for those on the P11D? Okay, employees not subject to NIC. This does happen. Now, by this, I don't mean old age pensioners who don't pay employee national insurance, but there's an employer, category C, employer national insurance only. This is really relating to, let's say you've got employees who come overseas. Let's say you've got overseas subsidiaries, branches overseas. Overseas employees come to work in the UK on assignment, let's say. And typically, if they've come from an EU member state or a country with whom the UK has a reciprocal agreement on Social Security, there's a few of those, and most notably probably the USA, Japan, South Korea, Switzerland, Norway, etc. If they come from those countries, they've got an A1 or a COC. That means they're not subject to national insurance at all. So they're not subject to Class 1 national insurance, but also crucially, if they're provided with taxable benefits while working in the UK, those benefits are not subject to Class 1A national insurance. So for Class 1A national insurance to arise, you have to meet two conditions. Number one is the benefit's got to be reportable on the P11D in the UK. It's got to be a taxable benefit. And the second one is the employee themselves have to be subject to national insurance and have to be subject to Class 1 national insurance, albeit you might have an old age pensioner, but they're still subject to national insurance legislation. So you've got that Class 1A charge. So if they've got a valid A1 or a COC certificate of coverage, That means they're not paying national insurance. So don't forget, in that case, to flip over the P11DB or doing it electronically, look at doing the adjustment on the other side to deduct their benefits from the total value of the benefits upon which you're assessing Class 1A. One other occasion where that might occur is for individuals who come to the UK where they're employed overseas, ordinarily, they're not ordinarily resident in the UK, and they come from a country outside of the EU and a country with whom we've got no reciprocal agreement. So, for example, India at the moment, although there is a direct contribution treaty coming up with India, but at the moment, if they come to Australia or whatever, they get a 52-week NIC exemption. So again, if they get benefits, they would be they're not subject to national insurance for 52 weeks. So again, you wouldn't be looking at paying Class 1A on those benefits for those individuals. And conversely, if you've got employees outside of the UK, but I've got A1s with HMRC, they're subject to national insurance, we're working overseas. Typically, they're broken UK tax residents. Typically, there's no UK work days. So in that situation, the benefits provided overseas are not reportable in the UK. So in that situation, there would be no Class 1A national insurance payable on that benefit in kind. There could be an equivalent social security charge in the country where they're working. But of course, they've got the COC or A1, so that would mitigate that charge. They remain subject to NIC only whilst working in the host location. So can we next slide, please, Katie? So that's been a whistle-stop summary of P11Ds. But what if you don't want to actually report the benefit on the P11D? This can occur where you provide employees with benefits and you really don't want them to pay tax on that benefit. Common example would be, let's say you've got an Employee of the Month award. They're given a voucher, typically. It doesn't fall within any exemptions. It doesn't qualify for trivial benefit, even if it doesn't exceed 50 quid, because it's a reward from employment. And so that is a taxable benefit. It is a bit mean, I'd say, to report that voucher on the employee's P11D. They've done a good job. You've rewarded them. And then you'd report on the P11D and they pay tax on it. It's not the best way to keep good employee relations, I would say. So what you can consider then is enter into the pay-as-you-earn settlement agreement with HMRC. Many of our clients do this, and this is where you as the employer essentially pick up the tax bill on behalf of the employees on those benefits in kind. I think the most common ones would be if they do another slide, Katie. Have you got an example there? So typically you'd have like staff lunches, meals and entertainments. This is where it's not like, I'm in an office now, we get refreshments, we get coffee, fruit, etc., etc. If you provide refreshments that's available to everyone in the office, that's not a taxable benefit. It's called the canteen exemption. So you've got an exemption from tax for those costs. But let's say you and your FD go for a lunch to discuss work. Although you're discussing work outside of the office, and you might think that's a legitimate business event, which, some may say it is, but unfortunately, that is a taxable benefit across that lunch. It's a working lunch. It wasn't available to all. There's no clients present. You've got a tax charge on that lunch. So again, you don't want to necessarily report that in the P11D. Another problem is how do you evaluate it? If it's staff entertainment in general, how would you evaluate the value of the benefit for each employee? So it's a good one to go into the PSA. Travel hotel expenses, this can occur where, let's say you pick up the expenses for someone, you provide accommodation and travel to someone who's at their permanent workplace. Crucial, the tax relief only applies where it's a temporary workplace. So if it's a permanent workplace and you're meeting somebody's travel, that's a taxable benefit. Relocation expenses above 8K can go in to PSAs. As I mentioned earlier, staff prizes, vouchers, long service awards that don't meet the exemption can go into PSAs. Trivial benefits over £50, such as wedding, birthday, Christmas gifts, they can go in. Two things with trivial benefits to be aware of, though. Number one, if you've purchased, let's say I took the team out for someone's birthday, I put it on my credit card, I came back into the office the next day, put in an expense claim, and the company reimbursed me for that event. HMRC's view is that does not mean trivial benefit because I'm getting a cash reward, which seems a bit contentious to me, but that's what they say. So be careful again. If you've got these events, try and arrange it directly with the venue, or if you've got a company credit card, use that instead. Try not to use your own credit cards or debit cards when treating your staff to, such as birthday events or whatever. And also with trivial benefits, as I said earlier, if it's a reward for the employment, it's taxable. So again, these things can be bear in mind, but these are typically what we find in PSAs where employers don't want to report it on the employment day. The application itself is made online. You only have to do it once. You used to have to do it annually, but you don't have to do it anymore. The annual calculation itself is done pretty much July, August time, September, submitted to HMRC. The only thing, big drawback with PSAs is they're very expensive because you've got to gross up the tax. So because you're meeting the tax liability on behalf of the employee, that tax that you're paying on their behalf, because that's their pecuniary liability, that's then seen as an additional benefit. So you've got to gross up the tax by the appropriate marginal tax rate and also pay national insurance, Class 1B national insurance, as opposed to Class 1A, Class 1B, and that's payable not only on the benefit itself, but on the gross up tax being paid by the employer. So it's an expensive way of doing things. If you look broadly at high rate taxpayer, 4% taxpayer, let's say they get £100 of benefit that goes into the PSA, you're going to be paying roughly £91, £92 in tax and national insurance on top of that £100 benefit. So it's a very expensive way of doing things. But again, many employers will use them because they don't want employees to be taxed on certain benefits. Payment deadline is 22nd of October. Interesting with PSAs, there's no mechanism to penalise you if you're late with the payment itself, but you can be charged interest. So just bear that in mind. Interest rates are quite substantial now as well. So if you've got a PSA, do the calculation and get it paid by the 22nd of October. And I think, Katie, that's me. Yes, it is. We've got some time now for questions. I'm going to hand over to Amy.
Thank you. We haven't actually had questions submitted, so obviously you both explained things perfectly clearly. I know you did really well. There is one question from me though, George. I know you talked a lot about the things to look out for with P11Ds, but when you're helping clients, what's the most common error that you see?
I would say it was that last slide, Amy, the director's loan accounts are overdrawn. I think there's just a general, people just don't know that that's a benefit in kind. I think it's just general lack of knowledge that is the case. They think because, I don't know, it's the director's loan account, many look on it as personal funds, I think, rather than company. They say, well, we'll clear it with a dividend, etc., etc. Yeah, that's all well and good, but typically there's this there's a benefit in kind charge, and again, more often than not, it'll be a Class 1A charge that's reportable, but it is definitely the DLAs, the overdrawn DLAs, I'd say is number one. Number two, I would say, is company cars and having to push back for the additional information. Having to, do a bit of investigation into list price for second-hand cars, etc. Was there any accessories? What is the mileage only on a FEV? That's often, well, people won't know. But again, you can see from the slides, it can make a big difference between the company car percentage. If the higher the electric oil range, the lower the company car percentage. And then, good old VAT, just people forget to add VAT. That's crucial. You've got to add VAT. The VAT inclusive of price is the reportable benefit for PSAs and P11Ds.
Yeah, thank you. You mentioned you went through various examples, so just to let everyone know, you will get an email with a link to the recording of the session if you do want to refer back to it. But we are finishing just 5 minutes early, so I think it makes sense to give everyone 5 minutes of their day back. The only thing left for me to say is a big thank you to Katie and to George for presenting today, and a big thank you to you all for attending. Our next webinar will be in the new year, so look out for details on that. I hope you can join us then. Otherwise, thank you from us and goodbye.